So thank you for joining, guys. Always so fun to have these AIN kind of meetups virtually. I love hearing about what everyone's doing, and there's so much expertise in the group. I think it's tremendous. Because this was, I guess, the week of the halving, and for those of you who don't know what the halving is, we'll talk about that a little later. We thought it was really appropriate to have a conversation around blockchain and cryptocurrencies, and Bitcoin, perhaps in particular. So today we have two pretty esteemed members of AIN that are going to be part of the panel today. And then afterwards, as I mentioned, we're going to do a quick kind of like discussion. But we're going to cover sort of a baseline knowledge of what blockchain is, what BTC is, why it matters, and then open up the discussion for questions and stuff as we talk about Bitcoin and other cryptocurrencies as an asset class. But before we begin, I want to give Sam a quick chance to do an intro as to what AIN is and what our mission is. So Sam, take it away.
Sure. All right. Thanks for the intro, Ken. We're excited to host this third discussion. So as Ken mentioned, we're switching it up and we're presenting two panelists for the session. Our purpose for these roundtables and our discussions is to bring investors in the Asian community together and provide a platform to help each other succeed and prosper. So I'm glad to see that we have a great representation here from all over the world, and looking forward to the discussion.
Fantastic. So before we begin, maybe Kevin and Michael can have just kind of do 30 seconds about who you guys are. And then, you know, let's do the round the room and then jump right into the panel. So Kevin, would you like to tell us who you are and what you've been up to?
Yeah, sure. So I'm Kevin. I am the founder and CTO of Trimwire. It is a startup. We just finished Y Combinator in March, and we focus on making smart payment systems and spend control systems for businesses. I am also very involved in the cryptocurrency space. I have been for a while. We actually pivoted to Trimwire. The previous idea was on using blockchain technology since late 2016. So have seen everything from the rise and fall, like all the different technologies that have been introduced, the ones that worked, the ones that died.
Very interesting. And I'm sure you have a lot of things to share about Y Combinator and your experience there as well.
Yep.
Mike, do you want to take a second to introduce yourself?
Yeah, sure. Hey, I'm Mike. Nice to meet you guys. I'm living in Indianapolis, and I left ConsenSys in February, but before that I was working there for a little over 2 years. So I've been working with Ethereum for quite a while, worked on various different startup projects within ConsenSys, ranging from education to digital identity to sports and supply chain management. So just experimented a lot with different products, trying to find viable use cases for the Ethereum blockchain in industries. And yeah, been on my own since then, working on a personal project.
Is your personal project still in stealth mode, or are you able to kind of share a little bit of what you're trying to do?
No, it's still in stealth mode, but it's not blockchain related.
Okay, awesome. Great. So we're going to take maybe 5 minutes to just do about 15, 20 seconds, everybody in the room, since we've got a pretty tidy group. So, and then we'll jump into the panel. So first name I got on there, Justin. Welcome back, Justin. Want to give us 15 seconds about who you are and what you're up to?
Yeah, sure. Hey, Ken, good to see you all again. I am currently working in principal investing strategy role at Morgan Stanley. I have some brief experience helping launch a diamond-backed crypto back in 2017, and that's kind of when I first started following the industry more. And if you guys are curious, that ICO I think went nowhere, but I'm not sure.
Great. Let's go to Koshik.
Hey guys, I'm currently a data scientist at Capital One. I've been a data scientist in tech for about 5 years. I got into crypto in 2017, and I'm mostly have been exploring like different quant trading strategies with it, and built a few just like apps on Ethereum on the side just to play around with it. But I'm mostly interested from a quant trading perspective.
Awesome. Michael?
Hey, I'm Michael. I'm a software engineer at Stripe in Tokyo. I just moved here from the San Francisco Bay Area, where I was working at a series of YC startups, previously Gem, Dropbox, a small one that, and then Pixel Apps, a small one that was acquired by Dropbox. I'm interested in blockchain, but somewhat of a skeptic still. Bought a couple Bitcoin at 1,000, then some altcoin, and that's about it. And just follow the news.
Sweet, thank you. Ryan from SF.
Hey guys, I'm Ryan. I'm from the San Francisco Bay Area, and I'm doing marketing automation at a cybersecurity firm over here. And I am pretty new to Bitcoin. I have read up about it, but I have not done any investment on Bitcoin. So just looking forward to learning more.
Thanks a lot. Sheena, do you want to go next?
Hi, everyone. Probably on the same page with Ryan. I don't know anything about cryptocurrency. I don't know anything about this, but I'm actually really excited for this because I'm here to just learn a lot about it. I'm one of those people who will dig into things when I'm really interested in it. So really looking forward to a lot of the material today. Oh, and I forgot, I am an instructional designer for healthcare systems. So I help build training environments and training patients for our hospitals, Zuckerberg General Hospital.
That's interesting. Cool. We got 2 more guys left here. Chris, you just joined recently, correct? Chris is connected to the audio. Peter, you want to do a quick intro? Take silence as no.
It's so yeah, I'm not really invested in crypto. I've just been following the story for quite a while, and it's kind of interesting to see how it's changed from back in like 2011 to where it's now. So yeah, I'm just eavesdropping to see, where Bitcoin is right now.
All right, last but not least, Chris.
Hi.
Hi, Chris. Do you want to do 15 seconds intro? Who you are, what you're up to, where you're from?
Oh, okay. Yeah, sure, no problem. Yeah, so my name is Chris. I run a digital marketing agency. It's called Nomadic Advertising. I've been a full-time entrepreneur for 3.5 years. I also run a couple e-commerce businesses, and I'm currently doing option investing, stock investing. I have a new YouTube channel. It's called Trading Zen.
Oh, awesome. Fantastic. I know Trading Zen. Do you work with Kevin at all?
No. Yeah, Kevin's my alias online.
Very nice. We had this conversation over Facebook. I remember this now.
Kevin
Yeah.
Johnson is his alias.
Oh,
Yeah.
so mysterious.
Mysterious indeed. We can't even see him. Okay, so by the way, you guys might notice that we have some polls up, so feel free to just kind of like vote, and if there's any kind of information you want to share there. Love to hear like kind of where you guys are baselining your knowledge about this space, and then I'll share that. It could be interesting conversation points. Let's just jump into the panel. So, okay, back to Kevin and Michael. So first, let's kind of baseline everyone's knowledge on, what blockchain is why does it matter, and then how cryptocurrencies kind of layered on top of blockchains are so interesting. Anybody want to kind of take the mantle on that first, so that we kind of explain why it's interesting?
Sure, Mike.
Hey, yeah, I can go. So yeah, the term blockchain itself is just referring to a specific type of data structure. So it really just means a chunk of data called a block, and then one block points to the one before it, and they're cryptographically verifiable, meaning they have a bunch of numbers in them, and then someone that signed that can prove that they were the ones, using a certain identifier that they have, that they were the ones that signed that block. So it can be used in a decentralized system to basically create a write-only database where a bunch of people can send transactions into the pool. Miners can mine these transactions by generating a bunch of random numbers until they find one that matches a certain criteria to prove that they've done the work, and then send that off into the chain where everybody else can verify that it was in fact them that sent it, and that all the information contained within it is valid. So that becomes part of the chain at that point. And so the main point of this is that it lets all the people that are using the chain and reading the information off of it to trust that the data in it is correct without having to simply trust a central authority. So Bitcoin itself was basically the original cryptocurrency, and the blockchain data structure was invented as a solution to the double spending problem of digital currencies, and therefore became kind of the first application. Bitcoin became the first application of blockchains. So that's, I think, high level overview of what they are and what the point is.
And Kevin, how would you explain it?
Sure. If I may add here, just so that's at a very technical level, right? And for the people who aren't so technical, if you remember like Napster or torrenting, a peer-to-peer network, kind of think like that. There's this whole global network of computers that can store and process data. And kind of you can abstract this as the blockchain is serving as a ledger, right? People are basically writing like, this person sent this person this amount of money, when this person sent this person this amount of money, and all of them are timestamped. So if I send $50 to one person and I spend $50 to another person, and if somebody sends $150 to me, I don't actually need to take dollars and give coins and out and whatever in order to know. All I have to do is subtract and add to get the final balance of what I hold. And that basically what the blockchain does is it makes it impossible for people to fake these transactions. And if you just do the math, everyone knows, well, you know exactly how much money you have and who sent what money to you and how much money you sent to someone else, without really having to like have a bank or anything. So it's a very powerful concept, and it kind of seems very ethereal, really vague right now, but I'm sending a video that I personally found to be really helpful in explaining it to my parents, and I think they do a really good job. So I just sent it in the chat, and this kind of explains the concept. But a big problem that Mike mentioned is the concept of the double spending, which is, it's good and all that I can send transactions, but theoretically, I can fake this transaction or spend the transaction multiple times, right? I can send $50 to this person and $50 to somebody else if I have a bunch of debts, and essentially double spend money that I don't have. And the idea of the blockchain was to prevent this using cryptography. I'm not going to go super into the details, but you can trust that the math behind it is solid. It's the same kind of cryptography essentially that powers all your internet connection and everything. So yeah, that from a security perspective, that part is fine. The more interesting part from a security perspective and why people are hesitant to trust it, I think, lies in the concept of the decentralized nodes, which I think we can get into a little bit later as we talk about the halvening.
Yeah,
I think that's a good way to talk about it.
Let's table that part because that's very interesting a little later. So if I could sum up both of what you guys said, when Bitcoin was launched, basically after the 2008 financial crisis, Satoshi Nakamoto, who is a mysterious figure in this space, wrote a white paper with a libertarian bent, basically the idea that centralized banking cannot be trusted. And so he created this idea of a distributed ledger that solves not just, like you said, the double spend problem, but also is, as I said, distributed. It is verifiable, right? So you can go back on history, and it's sort of stored in different places. So there's no single point of failure. There's no bank that can fiddle around with the history of a transaction, for example, or who owns a coin. And what's come out of that has been this whole system of people contributing power, CPU resources to basically like serve the ledger. Essentially, they hold the ledgers in all these nodes all throughout the world, and that's why these miners are out there doing this mining. They're essentially collecting and storing data, but also solving a puzzle to get their reward over time. Does that kind of sum up some of the attributes of cryptocurrencies and blockchain in general?
Yeah, I think it's almost always difficult to sum it up because there's so many parts of it, which is why I sent the video. But
sure,
I think based on because when we were pretty much trying to launch an ICO 3 years ago, and just to help people who might be new to this, you do not need to know the math and the technicals in order to do what you want to do with Bitcoin. 99% of the time, you will not need to know it. It's good to know, but it shouldn't deter you from being interested. Just putting that out there.
Yeah, absolutely. But I think just to kind of give people the historical underpinnings of why it exists in the first place. Okay, so that's interesting. So then, why is Bitcoin so valuable then? What gives it its value in the first place?
Sure. So, like any asset, really, it won't have value if nobody wants it, right? So when people are like, oh, okay, why would you use Bitcoin versus US dollars? It's like, okay, well, if people want to use Bitcoin, they can use Bitcoin. But I think the real value in it obviously is in the supply. There are only 21 million Bitcoin. It's baked into the actual protocol. It's in the software. You cannot change that. It is not like the Federal Reserve. I'm sure everyone right now has seen the meme of money printer burr, like recently, everyone's seen that. That does not happen with Bitcoin. There is no Federal Reserve. There's no cabal of central banks. There's no concept of like OPEC or anything. It doesn't exist. So when Bitcoins come out, Bitcoin essentially enters the circulating supply through mining, and there can only ever be 21 million Bitcoin in existence. So if you were one of the lucky ones when Bitcoin launched in like 2009, like I think someone said like 2011 they were following it. Like if you had bought Bitcoin then and you didn't like do the stupid MIT thing where you pay for pizza with it, and you also survived the Mt. Gox hacking, then you would be very, very well off right now. And if you continue to hold it, and as long as the network doesn't completely fail, it will most likely go in value just because the supply is kept. So that's what really gives it value. It's difficult to say that Bitcoin is like it's not like an equity really. There's no company. It's not like a stock. You know, there's no earnings, there's no financials. It's really what people want to see, I think, is increased adoption. So the more people that are willing to take payment in Bitcoin, they're willing to hold their wealth in Bitcoin, the value goes up.
So you touched on something that was very interesting, Kevin. Is that this idea that it doesn't have intrinsic value in the sense that it only has market price, a market price essentially. Doesn't have earnings, doesn't have any other kind of attributes that you can apply that you might have in terms of a, you know, a debt instrument or an equity instrument.
Yeah.
There is this element of the miners devoting resources such as hardware and energy and time to solve the block, so to speak. And there's a cap on that. And so there's a certain amount of cost investment, but anything above that is considered profit and sort of the value that the market applies to it, correct?
Yep, absolutely. The value, I think people are always confused because you see a lot of technologists saying it has value because I just spent $100 of electricity to help mine this, and it's backed by electricity. But I think that doesn't give it value, right? It doesn't, just because you spent money on something doesn't mean that somebody else wants it. And I think the value that the miners give is in making sure that people can transact with Bitcoin without fear. It helps the network stay stable. It helps people adopt it. So I think that's where the value really comes in. But in terms of, you know, people are like, oh, should I invest in Bitcoin? I've even seen questions like, should I use my IRA to buy Bitcoin? And I don't even know if that's like possible to do for like exchanges, but you know, it's not a stock. I've seen people compare it to like digital gold, like a digital form of gold, which I think might be the closest form of it. But I consider it its own unique asset class.
Yeah, there's definitely this tension between the market price, what you would pay for something, and the actual value itself. And right now, people seem to be really kind of focused on the price as sort of a proxy for value, it sounds like, right?
Yep.
Just out of curiosity, guys, I'm trying to run these polls, and I'm sure you guys are seeing them. Are you guys seeing them?
Yes.
Okay. I've never seen no responses in the polls before. That's very interesting to me. Anyhow, and actually just to make sure we kind of cover our bases there, Michael, did you have anything to add to that? Because that was a nice intro.
Yeah, I think one aspect of it that Kevin also kind of alluded to when talking about people feeling safe using it and the security that the miners provide is kind of the concept of censorship resistance. And this comes from the decentralization. By not having to rely on a central authority to facilitate transactions, it means that nobody has to really worry that one day all of the Bitcoin that they hold will be unable to be spent, right? As long as the entire network is running, anybody that holds a Bitcoin has the same power to spend it as anybody else. So I'm not sure, what you guys think from an investment point of view, if that is a factor that matters, but that is just one of the kind of qualities provided by the blockchain.
Yeah, and one thing that I want to add here as a use case is I believe in 2018, no, it must have been 2019, I was advising a project that became very, very popular. So what it allowed was for pretty much Venezuelans almost exclusively to put their money in Bitcoin. That's essentially what it did. It was a project focused on helping Venezuelans understand cryptos, put their money in cryptos, and actually use that at specific supermarkets to buy goods. And it obviously, the value of that project skyrocketed as the Venezuelan, pretty much like their currency inflated to ridiculous highs, and everything was just running out. I think it went from like 400,000 like users to something like 6 million or something, or 400,000 addresses to 6 million addresses, I would say, because you can open multiple ones. And that happened within the span of like 8 months. So I think a lot of people, one thing that I want to add here is a lot of people in more developed nations like the United States, you see a lot of US citizens being like, when they talk about Bitcoin, it's like, oh, but like, why wouldn't I just use dollars? And it's like, put yourself in the position of, you know, a Venezuelan citizen. It's not the same situation. So, and that's another real interesting thing, both from an investing perspective and a usage perspective, is that it is a global currency and it is not regulated by financial markets. There is no market open, there is no market closed, there's no pre-market, there's no after hours trading. It's 24/7. You can use it all the time.
Yeah, you bring us some interesting threads there, Kevin. The notion that it's a bearer instrument, but also is a currency that has finite supply, so there's no ability to inflate the way that the U.S. government, for example, the Federal Reserve is doing today. It's not tied to geopolitical risks in that same way. In other words, code is law, and so manipulation doesn't affect the value of it. And so let's actually explore that a little bit, because I think there's all kinds of interesting things about the use cases which have contributed to the proliferation of Bitcoin and cryptocurrencies in general. And maybe we can touch a little bit on like the public blockchain, and then how there are certain private blockchains that are kind of offshoots on that over time as well, and what their uses might be. Because I know there's all kinds of projects happening on the Ethereum blockchain, for example. Bank of New York Mellon and a few other banks are doing sort of blockchain projects, private blockchain projects with their own coin, used for like international shipments and trade and things like that. Maybe you can kind of touch first on the aspect of like the use cases, and then we can talk about like the other kind of private blockchains.
So I think on public blockchains, Mike could probably provide a really good perspective because he's worked on various projects. And before he gets started, for public blockchains, in terms of the different projects, like I think it's important to divorce the concept of the like other public blockchains besides Bitcoin and Ethereum. Like other projects can exist without being like ICOs, because I know that from an investing perspective, a lot of people got scared after a lot of the ICOs failed.
Explain what ICOs are to people who might not know what they are.
Sure. So initial coin offerings, kind of if you think of the world we have today, you have Forex, right? You have foreign exchanges, you have foreign like currencies essentially, and you can trade like US dollars with like the yen or the Korean won or whatever. If you imagine a virtual world where Bitcoin is, let's say, like a virtual version of the US, obviously not, but like some large country, and there's other countries that also have their own virtual currencies. And I wanted to create a new country, and I wanted to create our own specific currency for that, then I would need to bootstrap that currency. That is kind of what the concept of an ICO or an initial coin offering is. You may also have heard the term like token sale, but the idea is that the founders of this network are trying to launch it, and they need to incentivize adoption. So they would mark out various pieces of the network. So if you're like, I'm offering 1 million tokens at $1 each, like that's like the public thing, then like they would organize the ICO or the token sale in sections. So you would do generally a pre-sale where you're like, okay, I know I said 1 million tokens, but really we're reserving 100,000 tokens for early adopters or investors, and it's going to be at like a discount, blah, blah, blah. So the idea is to get it started up as well as to fund the project so that they can go and build things. And the idea is that will increase the value in the project, which drives adoption and then drives the value of the coin upwards. So that's pretty much what an ICO is.
So some famous cases were like the Telegram project, right? Where they were trying to build this application called Telegram, and they had an ICO. They said, "Hey, look, if you want to be a part of this project, you can take some tokens that we're going to create, basically our own currencies, as compensation to help fund the development of the application." Right? Is that
Yeah,
an
absolutely.
appropriate example? Yeah.
Yeah. And I think Mike could probably share a lot on this stuff as well, and kind of his experience with ConsenSys.
Yeah, Mike, would love to hear your experience there with that.
Yeah, sure. So just to preface, I want to point out a pretty important distinction. So when Kevin was explaining how Bitcoin is essentially a ledger that you can keep writing to, and you're kind of writing these transactions of who owns how much money and how much is being sent to another party. One area where Ethereum differs from that significantly is instead of just putting transactions into this ledger, you can put code and you can execute the code. So using the same concept but taking it one step in another direction is using this whole system not just to run a ledger that is being computed continuously over time, but also running a virtual computer that is running code and computing new data, as blocks get created. So that's
Mike, just quick thought on that. That's super interesting, and actually an area I think I would love to talk more of. This is what they're calling distributed applications, correct?
Yes, exactly.
So maybe we can baseline everyone's knowledge a little bit on what that means, because it might be a little advanced. And just from my understanding, I'll kind of walk through that a little bit, and maybe you can kind of like clarify afterwards. But my understanding is that applications have always been sort of centralized. You either in the past have downloaded them, put them on your desktop, or you might have done them on the cloud with a software as a service. And it's always in a single centralized repository that runs executable or, performs all the functions that applications would. What this seems to mean to me, and I would love to get your input on this, is that instead of having it in a single place, the executable is stored in multiple locations, right? And you're actually running applications in a distributed environment rather than a single one. Is that correct, or am I misinterpreting that?
I think there are a few things to untangle here. One being where a program is executing and what is actually being centralized. So traditionally applications, even if you are running like a client application in your web browser, or you have a local copy of some data, say you're running like some kind of budgeting software, right? And it has some concept of what your bank account is and how much money is in there. You can't simply just change the number locally on your program, like hack your own computer and change the number and suddenly you have more money, right? Because even though that program is running on your computer, it's talking to the bank, and the source of truth of the information lives within a database controlled by the bank. So it really comes down to who controls the physical hardware and the data that represents the ground truth of how all the people in this application can interact, right? So with decentralized applications in Ethereum, it's still very much will run an application on a server on AWS or something. You're probably still going to be running, client code in a web browser. But the key factor is that some data, some variables that represent some information tied to an identity lives in the Ethereum blockchain. So this is just like another place where data can be stored, and the data that is stored there has different properties regarding access and governance compared to data that would live in the AWS cloud or a proprietary data center or something like that.
So that's so interesting, because I think, and of course, going back to like the value of cryptocurrencies, this goes back to like the concept of distribution, right? Decentralization, democratization in a way. It's just done in a way that the value exchange is now your ability to perform functions, and your, well, perhaps not functions right away, but more in this case, that there's a security, your identity, your access is kind of stored on a blockchain rather than in a centralized place. Is that kind of the correct interpretation of that?
Yeah, so maybe a good example to kind of wrap your minds around the implication of this is, if you consider Twitter as a platform, right? Like the company Twitter owns all their servers and owns all the data. So if you were to send out a tweet and they chose to censor it, they could just delete it or not show it or something like that. They have full power. And everybody that uses their platform kind of just has to trust them not to abuse that power.
Right.
But if you were to make an equivalent service running on Ethereum or on some kind of blockchain, the premise would be that nobody could stop you from tweeting, that whatever you feel like writing will get written into the application, and no one person or one party could control it, right? So short of a 51% attack of taking over the entire network and taking over majority consensus of the entire block production process, you can feel safe that what you are communicating is what you intended and what you sent, and all of the kind of cryptography involved in it provides a layer of assurance to everyone else that you actually said and did all that stuff. So yeah.
That's a lot to unpack, I'm sure, for people who are not sort of deep in the blockchain, but it does sound like the ideas of decentralization, consensus, those things are present in what's called distributed applications, essentially. And well, it has all kinds of implications, because there's ideas like the distributed companies, right? These kinds of things. Basically, everything is coded into the traditional incorporation documentation and things like that. Can I take a pause right there? I know that we just covered a lot of things, but any thoughts or questions from the audience before we go into like back to like BTC and talking about the future a little bit? Let's open the floor a little bit before we jump forward. Feel free to just unmute yourself.
I have a question on the halvening. Like, is this the right time to ask, or you want to hold it to the end?
Let's hold that to the end, because I think we're getting to that in a few seconds, actually.
All right, yeah, I'll hold that.
Yeah. Any questions on the blockchain itself and all the, like, just, in my opinion, mind-blowing concepts that we're just talking about just now? Okay. Yeah, and it's a little bit of, it takes a little exploration to just understand how impactful this could potentially be. But we can certainly have follow-ups to discuss other areas further. But Kevin, back to you.
Oh, yeah, so just to add something here, I think it's always helpful to attach the use case to the technology to help people understand. So like what Mike was saying with these DApps, decentralized applications, the concept of smart contracts or executing code with the blockchain. One cool thing you can do is anything that has value you can own and transfer. So what I mean by that is a really cool thing that kind of emerged, I believe, in 2018 was the concept of the non-fungible token. Essentially, what you would be able to do is you would be able to own collectibles. So I don't know if anyone has heard of things like CryptoKitties. That was a very popular project. And it sounds really dumb, but what it shows the potential for is any sort of collectible. So for example, this an interesting project idea was, I think this was actually ConsenSys, or maybe it wasn't, but the idea was that people would be able to design virtual real estate in VR. People would create worlds kind of like how Minecraft has it, and you would be able to associate a unique identifier that identifies the code that represents that real estate, and you would be able to own that, and you'd be able to sell it to other people. So there's a lot of interesting things that go beyond just the pure Bitcoin and just paying people for things. You can literally own digital assets. And I think people are getting a little more into it now, especially as, you know, people are spending more time on their computers. The easiest possible way to think about this, I think, is like, if anyone has played like a game where they have like a currency in the game, like RuneScape. I learned a lot about economics from RuneScape and MapleStory. So like those present relatively good mental models for this. But yeah, just try to think about it from the perspective of not really digging really deep into like, oh, like I have to understand like all the code. But if you try to pair it with like, if I can have a ledger where I can own any digital asset, I can create and own any digital asset, like what potential does that unlock? I think that's very exciting.
Yeah, and this points to sort of a confluence of a few incredible developments technologically over the last couple of years too, with VR and AR. There was something called Second Life that came out in 2003, 2004. And part of the Second Life concept was that you could own digital assets. You created this world. You could have a house, you could have a family, and a dog, and a few other pets and stuff like that. But then you could also trade. You could buy things. You could purchase land, and there was a currency that was built into it, I believe. And so this whole concept has kind of continued to evolve over time. Mt. Gox being an example where, you know, you're trading virtual currency for virtual assets. So it's very interesting to see that kind of evolve and then like cross over into real life. Cool.
Yeah,
but
can I just add on to that a little bit as well?
Sure.
So one of the later projects I was working on at ConsenSys was taking these non-fungible tokens and applying them to physical goods. So in this specific case, it was NBA jerseys. So during a live NBA game, you could have people bidding on a website and kind of virtually trade ownership of this jersey, which the stadium and the team itself could attach some kind of physical QR code or some kind of physical way to associate it with that digital address and kind of use this digital token as a proxy for ownership and exchange goods this way. So that was tied into a much larger use case of that in kind of supply chain management and the provenance of various goods. So tracking, tracking something changing hands across a lot of different companies, a lot of different entities in one single supply chain, and then being able to manage that in a decentralized way really solves the issue of requiring trust between all these parties for this supply chain to be set up.
Fantastic. Yes, and the element of trust is really interesting to explore in this too. So you've introduced some new concept, and also if you think about some of the things like we're talking about self-driving cars and IoT, there's a confluence of technologies here that, when combined with blockchain, actually become very interesting and very life-changing. Something I've been reading a bit about recently. I mean, just imagine you driving a Tesla. The Tesla drives itself to Manhattan. You need to park your car, and the self-driving car connects to a parking meter, does a handshake, exchanges currency, pays for the hour, all this done programmatically. And so the trust is in the code, the value exchange is in the currency that's on the code, and also it's done decentralized, so you don't really need to you don't have to worry about being hacked or anything like that, your data being hacked or anything like that necessarily, theoretically. So yeah, that's super interesting. Any other thoughts before we go down to like predictions? Okay. So Kevin and Mike, So let's jump back into BTC because it's the oldest, most has the most adoption, has the most dollars invested behind it. We've got several billions of dollars invested in infrastructure behind BTC at this point around exchanges. There's been talk about the Lightning network overlaid on top of BTC to accelerate payments. So there's stuff being built around it. Obviously, adoption's not quite there yet. Obviously, we can't pay for things using Bitcoin. But tell us what your thoughts are on where this goes in a few years. Do you think the value of a coin is going to be where it is today? Does it go down? Does it go astronomically? So we've heard, predictions of $250,000 per coin at some point. How insane is that? Or how realistic is that?
Yeah. So the interesting thing now is that there is adoption. You can see it. It's palpable. You can trade futures on Bitcoin now, which has its own implications because people could profit by trading Bitcoin without actually owning anything. Like you mentioned, Lightning Network exists, which for people who don't know, the idea is that a Bitcoin is designed so that it takes on average 10 minutes for each transaction to get approved. And it costs a lot of energy to approve this transaction because of the security. But the idea is that if you're spending $3 at Starbucks, it's kind of ridiculous to attach this kind of cost to such a transaction, right? So smaller transactions can actually be computed in a subset of nodes that are pretty much separate from the actual core Bitcoin blockchain. And they process a bunch of transactions within a time period. And when the time period ends, that all gets pretty much synced up with the real blockchain. That means that you can process transactions a lot faster and it's really cheap. So that's another form of adoption that we're seeing. So I think in terms of price predictions, the reality is nobody knows. Like everyone was buying because like, oh, it's halving. Should I buy? And the idea was that the Bitcoin supply is going to be cut in half. And therefore, with the same level of demand, it will go up. But that's not how first of all, that's not how it works. The supply doesn't get really cut. It's the block reward that's getting cut, and which theoretically would mean going forward, the circulating supply or the rate at which the circulating supply increases is halved. That doesn't mean that the supply itself has just cut from 21 million Bitcoin to 10.5.
Kevin, let me ask you something about that because there's the amount of Bitcoin that's being saved and hodled. There's the amount that's actually being traded.
Right.
And of course, you mentioned block reward is halved. Doesn't mean the supply is actually halved. Just means that what's potentially new coins being introduced becomes halved.
Yeah.
But then there's the economics of mining, for example, which you mentioned in a post recently too, where the economics of mining also becomes halved. So you have to, you have to be more efficient to get the same reward.
Yeah.
What does that all imply? What do you think?
So I was actually in 2017, I was looking for abandoned warehouses in Baltimore. And the reason why I was doing that was because there were a few investors who I convinced about where crypto was going, and they were interested in mining. So the idea was we were going to buy like 10,000 ASICs and put them in a Baltimore warehouse near Johns Hopkins so that Hopkins security covers it, because Baltimore is not the friendliest place. But the idea was that we would have this thing running and it'll be really profitable. But the two things I mentioned there is the ASICs and the warehouse. The warehouse is important because you need good airflow, right? It's a lot of electricity being consumed, a lot of heat being produced. So what does that mean? It means if you have a setup that has cheaper electricity or if more efficient electric usage, your profitability as a miner is going to be higher. And two, the ASIC is Bitcoin and other cryptos are proof of work is mined or supported using a various a variety of technical instruments, CPU, GPU mainly. There are versions of GPUs that are specifically designed for certain cryptocurrencies, and these are called ASICs. So what I foresee is pretty much like companies that produce ASICs are going to do better. I think companies that, and this is tricky, like I was looking at the concept of buying these ASICs and putting it in a warehouse and buying Tesla Powerwalls and getting a solar roof set up on top of the warehouse. So that was kind of what I was looking at. And what this means is, I think, is going forward, like back then that would have been really profitable, but now it's not as much because the block reward is now cut in half, but the price of Bitcoin has not doubled yet. So that means that my profitability as a miner is going down. So that means that I would need to become really efficient, or I need to join some sort of group that helps me kind of lower the cost or the burden of mining Bitcoin. And that's where the concept of mining pools come in. That means that a bunch of different miners, instead of trying to like compete against each other to mine a Bitcoin block and get the reward, what they do is they join this massive pool of all these other miners. And this has its benefits, obviously, but I think it also, and I think someone mentioned this in the chat, actually, Michael Xu mentioned this, coming with its own politics, because there are these mining pools that exist. Like, I'm pretty sure the main Bitcoin mining pool controls like 30% of the hash rate, or the ability to mine Bitcoin. And that poses a risk to decentralization, right? Because let's say I'm the head of the mining pool, and then like I'm able to like talk with other mining pools and effectively put together so much. We own so many ASICs and other GPUs that our ability to mine Bitcoin is essentially 51% of the total network's ability to mine Bitcoin. Then I can just say, screw it, I'm gonna put in a bunch of double spending, like I'm gonna like fake transactions, like every Bitcoin transaction from now on is going to me, like you can do these things. And I think that poses a great amount of risk. When I think Michael brought up a really good point about the politics of it, because organizing and managing these political relationships is something that is very difficult to do.
So if I could just jump in other words, you're saying that the number of people mining are going to be fewer and fewer because they need the economies of scale to cover their costs of mining.
Yeah,
and you mentioned like constraints like electricity and sort of like cooling and things like that, and also the hardware. But then that also means that the idea of decentralization kind of goes away too, right? Because now you've got all these nodes sitting in like 3 or 4 pools, like F2 pool and things like that.
Yep.
Okay. So what does that mean for the value then? I mean, does that mean market prices will be controlled by a certain few, or what does that actually
I think
imply?
it's really hard to predict the price because it's gotten so kind of diverse now, right? Like let's say that let's give one example, right? Halving is priced in, is what you hear a lot, right? Like it's going to go up a lot and then drop near or after halving, because all the traders and the whales, right, who are riding on the wave of FOMO, fear of missing out, are going to dump and take profits and then buy back lower. And the fact that they can kind of do this is a system where like there's a lot of speculators and traders that have a lot of effect on the price. It's no longer as simple as just people using Bitcoin and people mining Bitcoin, which is a much more clear economic model. So it's hard to predict the price, but I would say in a macro sense that the Bitcoin price is going to continue to go up. It is going to 100% suffer dips. That's never going away, right? But we're not going to see 3K. In fact, if you see someone saying like, oh, like wait for the dip to like 3K, don't believe a word of anything that they say, because most likely they're not waiting for the dip for 3K, right? Like you see a lot of people on Twitter putting out these crazy low price targets. I don't see that happening. I think it can dip to 8K. I think it can dip to 7K. I think it may even dip to 6K. It's possible, unlikely, but it's possible. But I don't see it going to 3,000, because if it goes down to like 3,000, I think the security of the network is very, very much at risk. And if we go below like the 3,000 levels, the low 3,000 level, that I don't see a very positive future for Bitcoin. So I don't think that's going to happen anymore. And
hey Kevin, can you talk about that more? Why like 3,000 in particular? And I read this a lot. Like, oh, if it gets below X price, then it kind of like ruins the network. Or like, I'm really curious why you think that.
Because it has to do with the efficiency of mining, right? So let's say you're a miner and you mined, well, okay, let's say you mined like you get rewarded like 6 Bitcoin, right? Then if you mine 1 block every month and you get 6K, and you're like, this is how I'm gonna live, like it supports my rent, everything. And then suddenly the Bitcoin, or let's say the Bitcoin price was like $1,000 per Bitcoin, and then it drops to like $200. It's no longer sustainable. And you have all this hardware that you've already set up, and you don't know when it's going to back up either, because it is speculative, and you are pretty much caught in a downtrend. And your decision then is like, okay, I have all this hardware that like I'm probably going to sell it, because if it drops any lower, then nobody will want this anymore. So like I'm gonna try to like cut my losses a little bit. So what that does is like people slowly start dropping out of mining because the reward is so low, right? Like, and I think the reason why people mine Bitcoin still, even though the difficulty of mining a block has gotten so high, is because they still believe the price will get really, really high. And therefore it justifies the cost of your electricity and your hardware and like maintaining your whole rig and everything. 3,000 level, I think, is just based on like pure, I guess, like a combination of understanding the mining rewards and TA. I think that's where most people have arrived as a safe number. Like if it goes below 3K, just jump ship. That's pretty much the consensus.
So my point with that is like, I think you bring up a fair point, but like Bitcoin, there's been many times right now. So for example, let's say the price is close to like 10,000. Let's just round it to 10,000. And if it drops to 3,000 over some time period, there have been many times, right, in Bitcoin's history where it's experienced a similar percentage drop, like from 10,000 to 3,000, that's what, 70%? Like there's been many times when Bitcoin has fell over 80, 90%. So like, what's unique about this time where miners would stop doing it? And the same arguments that you made before about like, mining equipment, ASICs, all the investment, I think have always applied throughout this Bitcoin's history. So I'm wondering, is there anything unique about this time that wasn't the case in previous times?
So I think the previous times, what you've seen is, like I said, it was nowhere near this complex, right? 2017 essentially brought on a crazy wave of speculators. It was like essentially like the gold rush. And I don't believe I don't want to say this word, but like the quality of people in crypto has gone down significantly since 2017. So there's a lot of speculation. There's a lot of risk for people just leaving. And if you let's say you've survived these dips before, right? But the dips keep happening, and then this dip lasts a little bit longer. The mentality is for people to pretty much just think of it like, okay, like maybe this is going in a bad place, and leave. And I'm not saying that they will. I don't think that if it dips all the way down to 3K once and recovers to 5K, that people will leave, because that is probably going to happen. I'm saying if it's very clear that the price movement is in a downtrend and it doesn't look like it's going to recover soon or at all, then that will incite a wave of people leaving. And if it hits a critical point where essentially the hash rate is falling so much, then that just pretty much just creates a negative feedback loop. And I think like the reason why that it's different now is purely just based on how much this ecosystem has evolved since like those times. It's just like not as simple anymore.
So wait, Kevin, what do you make of those people that are speculating astronomical numbers? For example, Shamath Palihapitiya, who's a Social Capital CEO, is really bullish on Bitcoin. He thinks mainly because of scarcity that the prices will go up to beyond 20K.
Yeah. So
what
like,
are those based on? What do you think those predictions are based on?
They're based on nothing. This is CT talk. Like we call it CT because it stands for crypto Twitter. People throw out insane price targets all the time, and 99% of the time they're wrong. And I would say 99% of the time they're not even following their own advice. Like they'll be like, "Oh, it's gonna dip to 6K. Don't buy now, you morons." And like in the background, they'll be like hitting buy orders. So the 100K number, I don't think it has any real analysis to it. Like I personally, like that's what I was like. So in like 2017, I started with about $1,500, and then I turned that into $120,000 just based on speculation. And I thought I was a genius, and I was not. It fell precipitously, right? After that, I've been trading purely based on uptrends. Like I don't buy dips. I only look at the angle of the wave, essentially, of the chart, and a few other indicators. And if it looks like it's going to continue to go up to a certain target, like, so let's say you have like T1, target 1, and you have target 2, and it passes target 1 by, let's say, like, I don't know, depends on risk portfolio. Mine is generally 10% above. Then I have 90% upside, and it looks like it's going to not fall below this target. Then I buy in, and I sell incrementally up to the next target. If it passes that target, then I buy incrementally back in. So like, that's kind of how I view the pricing of crypto right now. People who throw out crazy price targets, I definitely don't recommend following that, because you can very quickly lose like all your money.
Yeah. Well, let me just take a pause, because I think there's a lot of comments and questions happening in the chat.
Yeah, I've consolidated some of
There's a lot here.
the questions. Maybe we can ask on behalf. I think Ryan had a couple questions. One was, what's a reasonable investment strategy for Bitcoin investments post-halving? And also, he has some friends who have been dollar cost averaging Bitcoin and I think other cryptocurrencies. And what impact does the halving have on that strategy?
So on the halving piece, and it depends on like what you believe, right? Like I'm not gonna say that like I didn't join crypto in 2009. Like I didn't read the Bitcoin white paper until 2016. I'm not an expert by any means. What I do know is that I haven't really lost on a crypto trade very much. Like I haven't lost more than 1% of my portfolio on a crypto trade ever, and I'm up 300% this year following this strategy. And this strategy will change probably. Like it changes like all the time. The idea is that like this is not a risk. All investments are not risk-free, but this certainly is not like a safe thing. Like if you don't believe anyone who says like because of inflation and because of global crises, the Bitcoin price is going to go up. Like you don't know that that's going to happen for sure, especially because there's not really KYC, AML in Bitcoin. Like it's impossible to really track who owns what amount. There could be like some whale who owns like a crazy amount of Ether back when it was a tiny price. And then, I don't know, like maybe his dad has to get a crazy surgery and he needs to dump a bunch of money, or like maybe like someone's after him in like a country and he needs to dump a bunch of money, and then that can crash the price. Like you have no idea what's going on, right? And that's the first thing you should understand. DCA, I think, is a good strategy because number one, it frees you from emotion a little bit. It frees you from the psychological burden of just watching a chart, especially one that is 24/7. You just put in like, if you believe in where the technology is going, just put in like $200, $300, whatever per month, and just relax, right? And over time, you're probably going to do well. And then I think I see another thing on, yeah, TA. I would say that TA certainly, like most people view TA as just like Crayola, drawing pretty pictures that, don't really work out in the end. What I will say is that TA offers you a relief from trying to make your moves just based on like fundamentals, when really there aren't like a crazy amount of fundamentals. Like there is no financial statement for Bitcoin. There's no financial statement for any currency. You can look at the hash rate, you can look at the number of addresses and whatever, but that's nowhere close to being able to be like, okay, their profit is up 17% year over year. It doesn't work like that.
Yeah, I always laugh when people kind of look at technical analysis as a guide. And so to full disclosure, I own a few Bitcoin, but I've always been someone who bought and held and just watched it kind of go through its motions. And so far, the value of my coins have obviously been up, but it's not based on anything other than you cannot base it on economic cycles. It's the reason why people invest in Bitcoin in the first case is because it's uncorrelated to any other factors. Even the halving was entirely unpredictable. So anyway.
Exactly. So it's very unpredictable. Definitely do your research. What I will say that what TA has kind of helped me do is, number one, not get greedy, right? Like people are aiming for crazy returns. Like I would say there's more greed in crypto than there is on Wall Street. Like people are aiming for like 10,000% returns in a year. Like, are you insane? That's what, how can that be a reasonable target, right? Like, I'm generally happy. Like my rule is if I make 30% profit, I sell 50% of my position in that coin, always. And I think like it's important for you to understand your risk. And I would say like for people who are looking to invest, if you're willing to invest $1,000, like you've earmarked $1,000 to invest in trading, start with 10%. Only put $100 and put it into Bitcoin. Don't put it into anything else, because generally, as Bitcoin moves, all the other coins are pretty related to it. So put 10% in, $100, see how it goes. Put like 5% of your portfolio in, let's say, an altcoin that you believe in. And then if it drops, I don't know, so you put 5% of your portfolio in, it drops like 10%, then you would only have lost 0.5% of your total portfolio, right? So like starting out really small, incrementing, you can increment on DCA, you can increment whatever way you want, but just make sure it's incremental. Don't go all in. Like I've seen people who are like, oh, halving is coming up. Like I just got a $25,000 inheritance. I'm gonna put it all into Bitcoin. Like, don't be that guy.
Hey Kevin.
Understanding the risk tolerance is very important.
What is
Go ahead, Kushik.
Yeah. So I know you mentioned if the price got below 3,000 for a while, that may make you want to sell it. Like, so what maybe like besides from price, like what fundamental like event or macro event could happen, or what evidence would you need to see for you to be like, okay, I'm going to sell all my Bitcoin. Like this is done. Like, is there anything that could happen like fundamentally to it that besides the price that would make you completely give up on the thesis?
Yeah, I mean, political struggles and hacks, like anything that compromises the security of the network is just bad, because that's literally the number one thing, right? Like if the security disappears, you have no idea if any of the transactions are valid. it loses its entire value as a currency. So anything where you see like one mining pools is now owning like 45% of the network, like that's a really bad sign. Or if you see like let's say like a major exchange got hacked, like for example, I know like Binance was hacked a couple of years ago. That was pretty bad for the price, I think, if I recall correctly. Yeah, like things like that, that's really bad. Things that are good, on the other hand, are concrete signs of adoption. So there is an article, I'm sure you can look it up, it's by Cointelegraph or Coindesk. But if you look up like Square, or I think if you look up Square or Cash App Bitcoin profit, you'll see that they made a lot of money on Bitcoin transactions in the last earnings report. That's a good sign because it's showing adoption. Like people are willing to transact using Bitcoin. So anything that drives adoption like that, I think is good. Anything that compromises security is bad. That's my general thing. So like when people talk about Bitcoin fundamentals, it's really three things. You want immutability, right? And you want transparency, and you want decentralization. These are the real fundamentals of Bitcoin and generally crypto in general, like for almost all cryptos. Anything that compromises these three things are bad. Yep.
So to follow up on that, Kevin, so given that they're in the halving, there are a lot less mining pools, or fewer mining pools that are bigger. And now that we are also using these big exchanges like Gemini and Coinbase, what do you think is the probability of more hacking like that then in the future? It sounds to me like it's going to be much more likely then.
Oh yeah, people are getting scammed all the time. Like there's Ponzi schemes, there's hacks, like people are getting really hacked. And I would say like for people who are using exchanges, I'm pretty sure every exchange requires 2FA. If an exchange does not require you to use two-factor authentication, please do not put your money in that exchange. That's like golden rule number one, just like an easy one to remember. And I just try to create I have a separate email address for my exchanges, all using Proton Mail. I don't put out any of they're all separate passwords. I change the password often. I have a cold storage hardware wallet. I really like the Nano. I bought the Nano Ledger S a couple of years back. I keep a lot of crypto, really just Bitcoin actually in there. Exchanges are mainly used for converting Bitcoin to altcoins and trading. If you believe in Bitcoin, if you believe in blockchain and you want to hold it, put it in a cold storage hardware wallet and don't lose it. And write down your keys and don't lose that either, obviously. But yeah, security is a super high risk. I certainly don't recommend using the same email address or password or anything for each of the accounts that you make.
Awesome. We're running up on the hour, so to speak. So why don't we ask for sort of your bold predictions, and then we'll do a final round around the room. Kevin or Mike? What are your bold predictions in the next 10 years, let's say?
Sure, I can go. I would say that definitely the blockchain fundamental technology itself is here to stay, and there certainly will be viable use cases in the economy, and definitely will be products that utilize blockchains. But I don't think that all of the coins and all the public chains as they exist today will necessarily persist into the future. I think all of these are very experimental still, and it's not that hard for new technological advancements to just create a new wave of coins or a whole new set of things that still use blockchain, but kind of leave these all behind. So yeah, that's pretty much my prediction. I guess it's just that the underlying technology will be here to stay, but I expect the actual landscape of coins to change significantly over time.
Awesome.
Yeah, that's very valid. My prediction isn't so much on, I'm not going to predict price. I'm not going to throw numbers out there just because 99% chance that I'll be wrong. What I will say is that as someone, as like an entrepreneur who has experimented with literally so many ideas in the blockchain space since late 2016, I've talked with all the funds. We've tried to launch an ICO. We decided against it. Funny story on that. We were in Maryland. There was one other company. It was 2 founders or 3 founders. It was called Gladius Network that were based out of University of Maryland College Park. And they were building like a decentralized storage system on blockchain, and they're doing a token sale. And frankly, I was really jealous because it seemed to be going so well. They were raising millions of dollars, and I was like, man, if we just do that, and we asked for all their advice, SEC advice and whatever, and they're like, no, it's a utility token, so you're good. 2 months ago or 1 month ago, I saw the SEC cease and desist order, as well as a bunch of violations for that ICO. They lost all their money and they're being fined, and they're going to go to court. So there's a lot of projects, I think, like that, where it seemed really promising, and they just go too fast and loose. I think regulatory landscapes are changing too. So there's a lot of factors at play. But one thing that has never died down from all of the ups and downs that I've seen is the interest, is the continued and almost like an explosion of interest in security and privacy. That has not died down. So to give some perspective, right after the major cryptocurrency dip, I was talking to a fund called Data Tribe, and they're based in Maryland. The founder, the CEO, is super accomplished. He's been CEO 6 times. He was a former Navy SEAL. All of the people on that team, they're like CIA officers, and they were insanely interested in blockchain. They all hold Bitcoin. Like they read about blockchain like every day, and what that led to essentially was an interest in all the things that are kind of adjacent to blockchain. So things like cybersecurity, data provenance. We were working on zero knowledge proofs. So using other privacy coin technologies and abstracting that. So I think my prediction is that in this world where people are using decentralized currencies, people are working from home, people are interested in VR, everything is moving online, there is going to be a major need for anything that involves privacy and security. And this doesn't have to be like blockchain. It doesn't have to be Zcash and zero knowledge proofs and something crazy like that. It can be something so far adjacent, even something as simple as basic privacy education, like a platform that is really good for privacy education. So like my prediction is that anything that helps improve privacy and security is going to explode. I'm very bullish on that. I think I discussed it in the last roundtable as well, that everything that I'm looking at is based on like, you know, secure like storage centers and data centers and everything from a real estate perspective. So yeah, that's my prediction. As for the big price, I guess like blockchain and everything, I agree with Mike. I think it's going to only increase, and we're seeing more adoption. We're seeing more efficient things, but I think it's still good to be aware of the other factors that influence it, the internal politics, the technological kind of limitations. Yeah, so just be aware of all of that before making an investment decision.
That's really interesting. Maybe to dive just a little bit into the asset class itself, though, there's a lot of people buying into it as speculators. Will that shake out, or is it still a store of value, just not as much as a store of value as we think it will be?
I think it'll shake out. Like, I think with every major dip, people are shaken out. And with every major pump, more people join. And that's just the nature of it. But I think over time, we're going to see, like for example, just looking at exchanges, they're so much better now than they were before. Like I remember, like there weren't even mobile apps for this stuff. Like it was crazy. So I think we're going to see over time, like people, they're going to be speculators joining and speculators getting wiped out. But over time, I think the trend is going to be that we're going to see more knowledgeable people. People are going to do more research. The media is covering it more and more. And I think we're going to have a healthier ecosystem overall. Whether that drives the price up or down, I can't say. But I think that the adoption of blockchain technology and the adoption of cryptocurrency in general is probably only going to go up from here.
Very cool. Thank you for all those insights. So we've got 10 minutes left. I'm going to open the floor up. Anything you wanted to ask but haven't asked? Just raise your hand and just unmute yourself. Okay, go ahead, please.
I mean, I don't know if anyone else has questions. I don't want to monopolize all the questions here.
No, Koshik, go ahead. You were the first to put your hand up.
Cool. So this is more of a question for Mike on the technical side, and I think it's actually still relevant from an investing standpoint too. So with Ethereum, so I know there's been a lot of talk about Ethereum 2.0, and I think it's the verdict is still to be seen on if any of the apps built in like 2017, all these ICOs, like which ones are still around. But I think so with Ethereum 2.0 going to like proof of stake, I'm trying to understand better. Like I know generally it's supposed to help with scaling. That's sort of the main technical challenge that they're trying to solve. Like what apps maybe like weren't possible before with the proof of work model, or maybe now possible because of proof of stake. So like, I guess what potential apps are unlocked with this new consensus mechanism that weren't possible before really?
So this is an interesting question because a big insight during my experience working on this stuff is that sort of thing is rarely ever the actual limitation in an Ethereum project succeeding or failing. That is to say, the technical limitations of the Ethereum network itself are almost never the kind of tipping point or like the piece of the puzzle that it takes to get a product to take off. A lot of the time it will be that blockchain was never the right answer from the start, or that people are attempting to apply blockchain to a problem that really has nothing to do with it. And I think we are still on the edge of the phase of exploring the problem space in general to figure out which problems really do stand to benefit from blockchain to solve them and which ones don't. And the use cases that are gaining more traction right now are actually ones that involve private chains, just because with the amount of scale that it takes to run something on a public network, you're going to have all sorts of other kind of like political issues or organizational issues or different barriers to adoption besides the blockchain platform itself. And working in kind of consortium or enterprise settings where those factors are more easily controlled for creates environments where the problem space is much more constrained to something that blockchain can actually be applied to solve. So I don't really think that going to ETH 2.0 is going to cause an explosion of viable dApps that people are actually using. I think it's a slow process of figuring out from industries and kind of attacking the problems where the money is actually at first and solving those kinds of business use cases, and then probably off of the innovations along the way from that, we might begin to see mass consumer products start popping up. But yeah, that's kind of my take on it.
Can I follow up on that, Mike?
Cool. Thanks.
Yeah, I think
What needs to happen before?
yeah.
Sorry, I just want to follow up on that, and Kaushik, feel free to jump in afterwards. But what needs to happen before DApps become mass adopt? I mean, so just fundamentally, like, what needs to happen in sequence before people can begin building and there's value being created for people?
Well, I haven't seen anything that seems like it solves a very critical problem that most people have. And one of the biggest issues in that realm is that of usability and how easy it is for someone to actually adopt a blockchain solution and how well it integrates into all the other existing technology that people use in their lives, right? So a lot of things that are dApps that claim to like allow you to do certain decentralized things that you couldn't do otherwise also require you to jump through a lot of hoops, you know, download extra apps on your phone. There's a lot of cross-device experiences where just to simply log into a website, you need to use both your phone and the website, or possibly like a hardware wallet or some other device to sign a key or something like that. There's a whole host of usability issues that are not really anywhere closer to finding a solution. And a lot of it also comes down to these types of technologies being kind of, it's almost like a chicken and egg problem, right? Where in order for them to become usable, enough people have to be using them for the industry to start shifting towards trying to invest more in making it easier to use and all that. But all of that just comes down to the fact that there isn't really a problem that a large population has day to day that can only be solved with a blockchain, and certainly not one that is so painful and so convincingly solved that it's worth jumping through the usability hoops to get to right now.
And is form factor or the way users would access that part of the issue?
Yeah, the way users would access it, in that fundamentally it comes down to the problem of keeping track of a private key, right? Nobody can remember a huge string of hexadecimal digits. So how are you gonna type this in, right? Right now, all the halfway decent solutions involve having a specialized piece of hardware to offload that responsibility to, which again, requiring, you know, an extra physical device just to log into everything on top of all the computers and devices you already are using is a huge ask.
Okay. Sorry about that.
Yeah.
Go ahead, Kaushik.
Just to follow up on that, I think, you know, I'm not like super well versed in all the different projects, but I've been like exploring since 2017, and all the DApp I think I agree with you mostly, Mike. Like, basically how I view it, like, I think most people, they actually do want centralized apps for stuff. Because like of all the trade-offs that you mentioned, no one wants, people like having a nice UI and a nice UX and like having to, like, they want to be able to click forgot password and get their password back and like do all the things that you would expect from a normal. So the way, like the framework I use as like what's potentially useful is like, if you want an app to be decentralized, which in my mind is shorthand for saying like, oh, like censorship resistant, or like not being able to be taken down by a government, which is, for example, like I think one of the most interesting projects on Ethereum was Augur, like prediction markets, because that is something you actually do want censorship persistent for, because if you're naturally into betting and gambling on all different types of events, then you don't mind going through the additional hurdles of whatever UI challenges there are to be able to use that platform. And you want something where a government can't just shut down like a gambling network, because most governments will outlaw that. So I think the best analogy right now for dApps is like if something is illegal and it has like a lot of censorship resistance from the government, then that's probably an interesting use case to experiment with a decentralized application, but there's no guarantee that it will get adopted.
Yeah, definitely. Because everything is a trade-off, right? Implementing crypto right now has a high cost. So there's just naturally going to be a smaller pool of problems that, find that trade-off to be worth it. And yeah, it's not even just or I guess rather, like the consumer market, yes, is difficult to penetrate right now for that stuff, but there definitely is a lot of momentum in enterprise use cases because, like I said before, having the relationships of trust already set up between certain parties to where you can create a private blockchain and then deal with like a much smaller space of possibilities is kind of the only viable space right now where people are making like a lot of progress forward on making commercially viable products. And even for high security, like this goes back to what Kevin was saying, right? Where it's like people value privacy and security, and the fact that these blockchains, that's their major strength. So it's really going to hinge on the use cases that demand that. Like, so you'll have things like the government too, where the DoD is looking into using blockchain as a way to identify foreign agents in an area where the internet connection might be compromised or something like that, where this kind of cryptography can be used to securely pass information back and forth as well. So yeah, definitely a lot of the risk in investment had to do with the fact that in this new space, there's this huge rush of people wanting to just take this tool and use it for things and find problems that this is a solution for. But over the next few years, those efforts are going to be running out of steam as the initial hype dies down. And I definitely do think there will be a set of things left over afterwards that are more kind of reasonable and sound from an economic standpoint.
Yeah, and to touch on that, I think a lot of the use cases that I've seen gain a lot of steam. Like Mike mentioned, the military, the CIA, they are extremely interested in blockchain technology. Like I said, the people that I talked to, they mentioned a project, I forget what it was called, but the idea was that basically military bases, like black sites, they still need to consume resources. The idea is to have essentially a private chain at each of these centers, and there is a ledger that tracks how their resources are being used and spent, and this doesn't go outside of the center, and at a certain point it remerges with the rest of the chain and is reported back to the DoD. So they can have complete, like, the same thing, security, like privacy, immutability. I've seen other things also on supply chains. So food supply chains and drug supply chains. There is a project called Chronicled that I think was tackling this. This is super, super important. I know IBM was also doing a food supply chain project with Walmart, because the idea is that it's all good until it's bad, right? You have a breakout, and then you need to be able to trace that all the way back to the source as quickly as possible. Every hour that you haven't traced it, it exponentiates the number of cases. So supply chain logistics and supply chain applications of blockchain are very, very useful. I also think that anything that has to do with, like I said, it's a global currency and that needs to be taken advantage of. So for example, there was a project where in regions where they're like running out of supplies, like running out of water, whatever, there was a group that went in there and they basically established one central command that had a Bitcoin wallet. And people would essentially send Bitcoins to this address, and there wouldn't be any like foreign whatever fees. Like there's no complicated process. There's no people who don't have banks don't have to line up to go and get a bank account. They just get the currency and they can spend it at whatever vendors, right? So like that is a really, really promising solution. I think there are people who are experimenting with the concept of Bitcoin-backed loans right now in the United States because the PPP process was such a complete disaster for small businesses. And people were looking at like, why should we have to like the KYC and all that, like everything, if we just had this information on the blockchain and we could fund it using a crypto, then people could get their loans in record time. But we didn't have the infrastructure to support it. And now like a lot of businesses are out of business. So I think these are really some promising areas that blockchain could help out in.
That's awesome.
Yeah.
Thank you. Oh, go ahead. One last comment, Mike. Actually, we want to make sure we get on time.
Okay. Yeah, sorry. Real quick, just to kind of illustrate another contrast between a tractable versus intractable problem space involving crypto. One of the earlier projects I worked on was trying to make educational attestations and certifications. And while the technology is there to say, like, you know, give you a certificate on the blockchain saying you finished this course, a big problem of adoption of a thing like that is getting all the various institutions and companies to recognize the value of that, right? But then if you take a similar concept into a consortium of enterprises where people need to facilitate kind of corporate workflows more quickly and efficiently, that space is much more ripe to have all these companies agree on a set of attestations so that one company can, you know, issue a claim to an employee of another company authorizing them to do something or whatever, have a lot less dependency on highly coupling their internal systems and allow a lot smoother workflows between various companies.
That is, I think all the use cases are so interesting to me, and I'm interested in seeing and hearing more about these projects and how they're trying to apply them, given the attributes of the blockchain and how they can deliver value. I'm sure we can talk about this forever, and I actually would like to. So if we want to do this again, shoot me a note. Maybe we'll just have a roundtable discussion rather than just a panel, so everyone can chime in. Or we can do this with Kevin and Mike again. But nevertheless, thank you for joining. Special thank you to Kevin and Mike for making yourself available. We're going to share this recording over email and maybe make a few notes and shoot this out. But I hope you guys got some value today, and I hope you guys, you know, enjoyed the time to talk about this. So thank you.